Welcome to the inaugural episode of Kepler Trust Intelligence Monthly Roundup. Today I'm joined by one of our KTI analyst team, Ryan Lightfoot-Aminoff, to discuss some of the most notable news stories in the investment trust world over the past month. Ryan, thanks for joining us today.
Thank you for having me, Joe.
So it seems apt to start proceedings with Scottish Mortgage, which is the biggest investment trust in the sector. They had their annual results in May, as well as some activity on buybacks and their shareholder base. So let's start off with the buyback news first.
Yeah, of course. It's been quite the month for news for Scottish Mortgage, SMT, as we'll refer to it from now on. They announced a big buyback program earlier in the year, and it's really started executing in the last month. They had a single day where they had buybacks of over £300 million, which is a new record for the investment trust sector. And that's part of a plan to buy back, like we said, £1 billion worth of stock over the next couple of years. For context, this buyback that they've done in just one day is large enough to buy all of the trusts in the 20 plus strong smaller company sector, bar about 6.
Right.
So it's a pretty sizable investment. Since this total buyback plan was announced in mid-March, they're now around £490 million. So they're about halfway through the programme, which is starting to have an impact on the discount. This activity seems to have some connection with the activist shareholder Elliott Management, which previously appeared on the register, having taken around about a 5% stake about midway through last year. Elliott are known for their activist shareholder approach and are believed to have been encouraging the share buyback. This has clearly had the desired effect, and the discount is close to around 8%, having been in the 20s when Elliott is believed to have first built their stake. As a result of the buyback, Elliott are now back below the 5% stake where they need to report. So clearly they've done quite well out of this, and it seems to have had the desired effect, closing that discount. This activist approach is a trend we've seen quite a few times in the investment trust world. Saba Capital began building stakes in a number of trusts that were trading on wide discounts. So where this goes next will be interesting, though the pressure has arguably come off a bit with the recent market rally starting to close some discounts.
Some very interesting news there. So moving on to their results, what were some of the key takeaways in terms of portfolio weightings?
Yeah, so back on their results, the trust has returned to generating a positive return following quite a bruising and difficult couple of years. The managers in the results also declared that a third of the portfolio was invested in AI-related companies. This includes stakes in some of the key players such as NVIDIA, who design the chips, ASML, who make the machines that make the chips, and then TSMC, the factory that creates all the chips. There are also a significant number of companies that have been benefiting from applying AI to their existing businesses. These are companies that Scottish Mortgage already holds that are now starting to benefit from supposedly integrating AI into their companies. The managers say that these sort of applies to their transformational change approach. So it often overlaps with their key areas like transport, healthcare, and decarbonisation.
So that's interesting in terms of current investments. What have they pared back on?
So quite notably, the managers trimmed their position in a long-time holding Tesla.
Right.
This had been a really large part of the portfolio and one of the long-term investment themes, not just in Scottish Mortgage, but Baillie Gifford more generally. But the holding is now back to 3%. They've also exited their position in the Chinese mobile games company Tencent. This, again, had been a long-standing holding and marks a real change in sentiment from the managers towards China's prospects, particularly around regulatory concerns we've seen in December.
What about any other larger holdings that we haven't covered?
Moderna, a well-known pandemic name, continues to be a big holding despite having a challenging year. Although since the results period ended, the stock has done much better, having quite a strong rally. So all in all, there's been some really interesting portfolio changes in SMT. It's quite intriguing to see them talk up the prospects of AI, despite that not being one of the key features of the trust previously, although there is a lot of overlap with some of the themes that they already have in there. With all of the buyback shareholder activity, it really could be an interesting year ahead for the trust and for any shareholders.
So staying on the topic of corporate activity for a little bit longer, we've seen continued chopping and changing in investment trusts themselves, including some activity at Henderson.
Yeah, the month has seen sort of improved terms come through from a proposed combination between two Henderson European trusts. There's Henderson Euro Trust and then Henderson European Focus. Right. For background, this was first proposed in March, but the plan took a bit of a turn when the Euro Trust was approached for a buyout by an unsolicited firm. To try and push the original deal over the line, though, the board have come back with better terms. This includes the option for a cash exit being increased to 15%, including on the European Focus Trust, as well as a drop in the prospective management fees on the combined vehicle and a contribution from Henderson towards the merger costs. Furthermore, they've announced that there will be a new discount control mechanism as part of the new vehicle should the combination be approved. And this will have the potential of a tender offer every 3 years over the original 5, though it's still subject to shareholder consultation.
And any other particular advantages of that merger?
Well, one of the key perks of the deal is that it will be an increased asset base. This should offer better economies of scale that can be passed on to shareholders by way of lowering fees. It will also offer better liquidity for a trust that is likely to feature in the FTSE 250. We saw a similar move with the likes of JMI, which was JP Morgan's small cap trust, and JMF, their mid cap trust, which combined earlier this year. The new vehicle, JP Morgan UK Growth and Income, JUGI, is not far off promotion to the FTSE 250 itself. So that looks like it's gone down quite well. So it seems Henderson are following this path.
So returning to the topic of buybacks, we've seen a novel approach from Pantheon International come up. So can you talk us through that one?
Yeah, of course. A really interesting approach from Pantheon International, which is a private equity trust. Private equity has been, again, under pressure for quite a while. Yeah. Discounts have really widened out where people have become sort of skeptical over some of the valuations there are in there. What they've done here is they've tried to tie the buybacks that they're going to do to the level of discount versus the cash flow that's coming in from investments. So the method is really quite interesting and quite novel in its approach. How it plays out is yet to be seen, but I think the biggest story or the bigger takeaway from this is that even these alternative investment trusts are now recognizing the value in their share prices, and they believe they can offer good options for shareholders by buying back shares at a significant discount rather than investing in new holdings. And this should be taken really, we think, as a sign that they believe the trust NAV. They believe it's accurate, and they believe that going along and buying their own shares at a discount to a NAV that they have faith in is good value for shareholders. So now turning the tables a little bit, Jo, you've recorded a couple of podcasts. You've been interviewing some fund managers in the past few weeks. What are some of the interesting themes that have come out of these?
Yes, so starting off with the UK small cap sector, I spoke to Richard Staveley, who's the manager of Rockwood Strategic. And Richard, it's fair to say, sees plenty of opportunities in the sector, given that UK equity valuations remain below historic averages and also global peers, and in his view, very much divorced from fundamentals. I think in fairness, it's a topic that both you and I have covered on a fairly regular basis over the last year, and we are still banging the same drum on that front. But we've seen a lot of interest in UK small caps, particularly from financial overseas buyers in the last year or so, and that's proved a tailwind for returns, particularly for trusts such as Rockwood that has a high conviction, concentrated portfolio. But I think the silver lining is that the depressed valuations are throwing up some really good opportunities for UK small cap managers. So, for example, Rockwood has a holding in Filtronic, which is a communications equipment specialist based in County Durham. And its share price has been on an Nvidia-like run over the last year. It had a one-day bounce of 50% recently after announcing a strategic agreement with Elon Musk's SpaceX. Another strong performer for Rockwood has been Funding Circle, which you may be familiar with, but it provides funding to small businesses. So despite the UK small cap sector having one of its worst periods in recent history, I think small cap trusts such as Rockwood are still managing to deliver strong returns through their bottom-up stock picking skills.
Yeah, some really interesting activity going on there. And on the subject of M&A, there's been a lot of coverage in the financial press about the future of UK small caps. The famous Peel Hunt forecast came out that the index could be extinct by 2028, given the level of current M&A activity and the lack of IPO pipeline. Did Richard have any view or comment on this?
Yeah, I think it's probably worth saying at the outset, it's less concerning for a trust like Rockwood because they're only looking for 20 or so companies having a more concentrated portfolio. But Richard did feel that de-equitisation could cause a potential issue for active UK small cap funds. In terms of possible fixes, I think Richard believes that the IPO market is fairly cyclical, as we know, and it's likely to start to pick up once investor sentiment improves. But he also hopes for further stimulus, I think both from the government and also regulatory authorities.
And dare I ask whether Richard had any thoughts on the British ISA?
Absolutely. I think Richard was a little disappointed with the press coverage, which he felt was overly focused through the lens of the private investor. But I think he felt it was a welcome initiative, particularly as it demonstrated that action does need to be taken at the highest level. Richard had a number of other suggestions in terms of things like stamp duty, pension relief, capital gains tax, which we unfortunately don't have time to cover in this podcast, but you can find our full podcasts on the KTI website, as well as YouTube, Spotify and Apple Podcasts.
Yeah, I'd really recommend doing that. Richard has a lot to say, certainly on British small caps. You also sat down with Christopher Berrier, manager of the Brown Advisory Smaller Companies Trust.
Yeah.
That is actually another trust that we'll be covering in our event in the coming weeks. So could you talk us through a couple of the highlights that Chris had to go through?
Yeah, so again, the full podcast is available on the KTI website, but Christopher spoke about balancing portfolio concentration with diversification. So obviously not having all of your eggs in one basket, particularly in the US small cap sector, which, as we know, can be volatile, but also avoiding what he calls diversification, where you end up spreading yourself too thinly in terms of making the initial investment, but also monitoring on an ongoing basis portfolio companies. We all know about the Magnificent Seven, not least as they've been written about pretty much ad nauseum, and in fairness, delivered a stellar performance. But Christopher pointed out that 2,000 odd companies in the US small cap sector probably have less research coverage in a whole year than likes of Nvidia, Apple and Alphabet have in a day or a week. So this is where an analytical edge can really add value, given it's an inefficient and under-researched space. But I think Christopher also warned about overemphasising the growth piece for small caps in terms of revenue growth at the expense of bottom line profits. He also talked at length about boring being beautiful. So you don't necessarily have to fish in the sexier parts of the market, such as tech or healthcare, to find superior returns. And we've talked about AI already. It may not be as hot an investing topic, but some of the best performing companies are in sectors such as waste management, insulation and convenience stores.
And similar to what we said about UK small caps going through M&A, quite a high level at the moment, is this a similar trend that's happening in the US?
I think the answer to that is not entirely. I think Christopher's view is that the rise in interest rates has reduced activity in the US small cap sector, but this may obviously pick up as rates start to reverse. But BAS typically has 2 to 5 companies acquired per year, so M&A remains a feature of its portfolio, and most recently 2 of its energy companies were acquired by ExxonMobil and Schlumberger. So I think there's still a base level of M&A activity in the US small cap space.
So something, but not sort of a key driver of the market.
Not as much as the UK.
Yeah. So what about the outlook for US small caps over the next year or so?
Yeah, I think while UK small cap valuations are arguably in bargain basement territories, we've already discussed, Christopher feels that valuations of US small caps are fair on the whole. But he also talked about the extreme concentration of weight and returns in the S&P 500, and historically, when this level's been reached, it's eventually ended. So I think he feels we could see a period of favourable performance for US small caps when this unwinds. And he pointed out that a few basis points coming out of, say, Apple or Microsoft could have a significant impact on a Russell 2000 company. So in terms of results we cover, Ryan, you looked at Schroders this month and had 2 pieces of results analysis from their Asia desk.
Yeah, that's correct. We saw results from both Schroder AsiaPacific and Schroder Oriental Income towards the end of the month. Just as a quick recap for people who are not so familiar with them, these are both run by Richard Sennett, who is also joined by Abbas McCorder on the AsiaPacific Trust. The key differentiators between the two is that Schroder Asia-Pacific has a capital growth focus and can also invest in India, whereas Schroder Oriental Income has more income-orientated mandate as you'd expect. Doesn't have India in its benchmark, but does include Australasia, which allows the manager to pick up some of those banks that you see in the developed Asian market of Australia, which helps generate that extra income. Big drivers to performance on both trusts has been stock selection, which we think is a really encouraging sign. This has come predominantly through an overweight technology holdings, which is a big boost to performance on both trusts. The sector outperformed really well from a combination of, as you'd imagine, AI and those sort of names doing well, with the likes of TSMC being some of the top performers. Taiwan and Korea, big contributors here, but also the inventory destocking cycle as well. The industry's been sort of really ramped up and dropped back off again following COVID. So that's now rolling off. Earnings are starting to come back, and this has really helped the holdings. The managers also have a big underweight to China, which has helped performance. This has been long-standing due to slight caution over the government role and sort of economic issues as well, but it is still proving correct. In exchange, the managers are overweight Hong Kong, which was a drag to performance, but stock selection has offset this. In the case of Oriental Income, the stock selection in Hong Kong completely offset the overweight, which we think is particularly impressive. For more information on the results analysis, this is both available on our website, both for Schroder Oriental Income, which came out on the 23rd of May, and AsiaPacific on the 21st, for more details there.
And that's it for this month's podcast on investment trust news. We hope you join us again soon. And if you have any suggestions for content you'd like us to cover in future podcasts, please drop me an email at joe@keplerpartners.com. In the meantime, as we've mentioned, there's more information on the topics we covered today on the Kepler Trust Intelligence website. And thank you, Ryan, for joining us today too.
Thank you very much for having me.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorised and regulated by the Financial Conduct Authority.